Welcome to the Jay Tyner Show, where we discuss all things wealth management and retirement planning. And as always, the goal of our team here at Semmax Financial Group is to help you focus more on your life and less on your money. Now, as a reminder, check with your current advisor, planner, CPA, and read our disclosure in the video description below. Subscribe to this channel if you want to stay up to date on all of our new content. And by the way, if you have questions or need a 15-minute free consultation, please visit semmax.com or call 336-856-0080.
Hello and welcome. My name is Matt Landon. I'm joined by Kyle Leonard. We are both CFPs and financial advisors here at Semmax Financial Group. And today we're going to talk about something that I think there's a lack of transparency around. And so hopefully we're going to cut through the noise and explain this in a simple to understand way. And that would be an inverted yield curve. What does this mean? Should we be panicking? Should we be excited? Well, I think there's a couple things we need to set as a ground rules of understanding before we dive into what this inverted yield curve is. And by the time we get there, I think it'll make a lot more sense and be much more clear. So to start off, let's talk about yield. What is yield? Yield is simply what my portfolio or what my investments are giving me in paychecks. So if you have stocks that are paying dividends, they are yielding you dividend checks. Mm-hmm. If you have bonds, they're yielding you interest. Now remember, a bond is nothing more than an IOU. You make an investment, that's a loan, they're paying you back with interest. Now there's different types of bonds out there. There's zero coupon bonds that they mature at parity, which means I might give you $95 and I get $100 back. Others, you give them $100 and then along the way they're giving you drips. And then you get your $100 back. So there's different ways of doing that. We don't need to get tied up on all the different types of bonds. We can do a whole nother article just about that or vidcast. Gosh, yes. We could talk for hours about it. But the key thing I want you to take away with the core concept you need to understand is when I have yield, it is what is this position giving me in paychecks? So where does this tie in to yield curve? What is a yield curve? And you're like, what's this thing moving? So why don't you tell us a little bit about yield curve and kind of how that ties in with time and duration, and we'll try to make these as simple to understand as possible.
Absolutely, yep. So when it comes to the yield curve, what you're really looking at is based on whatever type of investment you get on the treasury scale, whether it's a 3-month, 6-month, 1-year treasury bond or a 10-year, 20-year, 30 treasury bond. How much are you getting back for that investment? Normally speaking, the shorter that you have in the investment, whether it's a 3 or 6 month, you're going to make a little bit less than you're going to make in a longer term investment in a 10, 20, or 30 year bond.
Now, here's an example. If I loan Kyle $100 and he pays me back next week and he goes, here's $100, and you know what? Just for letting me borrow it, here's another $1. I made $1 on that investment. Now, if I could make $1 every 7 days off of $100, I'd be pretty happy, right? That's a great, on an annualized basis, that's really strong. But if I said, okay, instead of tying it up for a week, you said, I want to borrow $100, but I want it for a year. I'm going to look at him and go, well, $1, that doesn't seem good enough. And you go, well, I'll give you $10. So I'm going to borrow $1 now. I'm going to give you $10 back, right? So that yield is being pushed higher. I'm making more money off of that return because it's a longer duration. This is a simplification, of course, because if you get into the time value of money and then reinvestment and things, but
absolutely.
The core concept here is the longer the time, the higher the yield, generally speaking, because you're locking it up. So that begs the question, what is an inverted yield curve?
Yeah. So the inverted yield curve is really, I would say, an investment phenomenon. As you're looking at the yield curve of the treasuries, right now it looks like at the time of this recording is that you're actually getting paid more money to keep your money invested in shorter term investments, which really is kind of backwards.
Right. So what that means is usually if I have a 1 year and I have a 10 year, the 10 year should be paying me a higher yield because I'm locking it up for 10 years as opposed to 1 year. But right now, if I invest in a 6-month treasury, it's paying me a higher rate than the 10 year or even the 1 year. Well, why is that? One of the reasons why is because when you're faced with a rising interest rate environment, Instead of locking my money in for the next 10 years, if I wait 6 months, the Feds raise rates. Well, hey, I can take it, reinvest at a higher rate. I'm not locking it in. Now, normally when rates are flat or if they're declining, I want to lock in that high rate for as long as possible.
Absolutely.
But right now, we're in that inverted yield curve. Now, this ties into something really key. Why do I care? Because the average investor is going to look at this and go, short term, long term, what difference does it make? Yeah. So, Kyle, in a nutshell, let's go through this. Why should I care about an inverted yield curve or a normal yield curve or curves at all?
To Matt, that's a great question. The biggest reason that you really want to care about this is consumer sentiment in the markets and in the economy.
Okay.
When you start seeing these inverted yield curves, it really plays into the effect that we may be heading towards a recession sometime soon. Do we know when that will happen? Absolutely not. We can't predict a recession.
Now, here's what's interesting. And you said, can we predict a recession? No. Well, I can tell you this for a fact. Every recession we have had has been preceded by an inverted yield curve. And you may have heard that. And it's sensational. And you go, whoa, now I'm nervous because he just said 2 minutes ago we are in an inverted yield curve. Well, we are. But has every inverted yield curve resulted in a recession?
It has not.
So it is an indicator, but it is not the end all be all, right? This is coupled with a number of other things that all come together to culminate in deciding, are we moving towards a recession? Are we not? There are environmental factors ranging from wildfires to hurricanes. There are political implications. What's going on in Washington? What's going on abroad, right? There are legislative. There is also just from the consumer sentiment standpoint, there is just overall, what are we doing from a purchasing standpoint? What is our GDP looking like? What is our output, both domestic products that we're producing, but also what are we spending? Where is our dollars going? It's not as so nuanced or so simple as to say the yield curve has inverted, ergo recession. But I think an inverted yield curve does pose an interesting question around how you have your bonds invested.
Absolutely, yeah. With an inverted yield curve, it is really prudent that you pay attention to the duration of your bonds. I would honestly argue that you don't want to have your bonds tied up in longer term investments.
So this is one of those things where when people ask, should I invest in a target date fund, or should I just kind of set it and forget it? I'm 65, so I should be 65% in stocks, and I'm 75, so I should be 75% in bonds, or anything like that. Any of those rules of thumb. I think any rule of thumb has value, but again, it's not the end-all, be-all. That's where I think that actively managed portfolio and an ongoing conversation with an advisor is key.
Absolutely. And as you said, active management. While we can pick investments, we need to make sure that we're actively managing those investments to make sure that you are in the correct portfolio and that we're paying attention. That's our job.
Absolutely. Now, is this trying to time the market? No. There's a big difference between trying to time the market and understanding market conditions. I'll give you a perfect example. Timing the market is trying to decide, okay, should I buy a watermelon on Tuesday or should I hold off until Thursday because I think it's going to go on Vic's special at Food Lion, right?
Yes.
That doesn't work. Buy the watermelon. But here's what does work. Going to the grocery store and realizing it's the middle of February and watermelon is $11, but I can get this other produce like squash for a fraction of the cost. What we buy and how we spend our dollars, where we allocate funds is going to differ depending on the conditions, right? That said, if you're interested and you want to have an ongoing conversation, or if you potentially want a complimentary review, one of the advisors here, we would be glad to do an analysis and a review for you. If you're interested, you're welcome to reach out to our office. You can contact us through a number of different sources. That said, on behalf of Kyle, myself, and everyone here at Semmax, thanks for watching. We hope you have a wonderful day.